Let's get reaction to the market close. Jeremy Siegel, Professor of Finance at the Wharton School of Business and Chief Economist at Wisdom Tree. Very good to see you, Professor, as always. Long time no speak. I just wonder whether you see a little bit of a close today. It's only one day's close, of course, and you think, yeah, that makes sense because we're on track, whether we look at it 10% up year to date on the S&P 500 or one statistic that jumps out to me, we're on track for 5 months in a row of gains. Are we due a little bit of a pullback?
Well, I wouldn't be surprised, although I still think the momentum is there, Will. I still think this bull move is strong and has a ways to go. Yeah, I mean, you could have little corrections under the way, kind of head fakes, but you know, I think the news is strong. I think the inflation is going to be being reduced. I saw a GDP estimate by the Atlantic Fed. This came out after the durable goods at 2.1%, exactly the target of the Fed this year. So the economy is not showing signs of weakness, and surprisingly, 12-month earnings forward, instead of usually they go down as the year goes on because they're often overestimistic, are actually rising in many circumstances. So I still think, yes, we could have even a 5% reaction, but I don't think this bull market is over.
Well, let's talk about inflation and what, of course, that then feeds back into rates in the market, because obviously we get PCE on Friday when the market will be closed. Well, earlier today on Squawk on the Street, excuse me, it's been a long day, Professor Siegel, I was talking to James Gorman. Let's hear his take on rates.
I would be surprised if they move in the first half of this year. I would not be totally shocked if they don't do anything for the rest of the year.
Professor Siegel, no rate cuts at all this year. Do you think that's possible? What would it do to markets?
It is possible. Torsten Slok is another economist who came out with that a couple of weeks ago, and I think it's unlikely. I think it's against the odds. But very honestly, what's more important for the market is the state of the economy and earnings going forward, to whether the Fed lowers it in June, July, or even December, as the case may be. Now, I still think the odds are definitely that they're going to lower it, but I think people are beginning to realize that they're going to be buying stocks for earnings more than what the timing of the Fed rate cuts are actually going to be.
So if we step back, whether it's in the short term and the S&P's up 10% this year despite rate cut expectations coming down significantly, or longer term since the sort of October 22 lows, do rates not really matter, and multiples for stocks will kind of ignore rates altogether?
No, multiples, they matter. I think we're looking at 21 times forward earnings on the S&P. Now, you know, that is slightly rich. I've often argued that about 20, I thought, is the equilibrium. Now, of course, if you take out the Mag 7, you're down to about a 17 and 18, which is, you know, more reasonable. You know, I still think we have a bifurcated market here. And that doesn't necessarily mean it's bad, because those stocks have generated the bulk of the growth of the earnings. But when I look overall at the market, I say, no, it's not cheap. But it certainly is not something that I think any long-term investor should avoid. And particularly even an intermediate-term investor, I think, is going to be rewarded.
I wanted to get your take on gold, which, of course, has broken out to highs recently. At the same time, of course, Bitcoin and cryptos surged once again. Are those sensible investments at the moment?
Well, the long-term return on gold is 0.9% after inflation. And that's over 200 years. So you can certainly get a spurt in the short run, but in the long run, it pales with respect to almost all the other assets. It's a store of value, and with a little bit of gain beyond that. Now, given all that, I was really excited about gold early when inflation started, and it didn't move very much, and everyone went to Bitcoin. And I sort of said, yeah, you know what? The millennials' new gold is Bitcoin. They're not interested in gold much anymore. It was really a disappointing investment at the beginning of this inflation period. But I think it's in a catch-up mode right now. But I really am not a fan of gold as a long-term investment.
Robinhood unveiled its first ever credit card and a redesign of its brokerage app. And joining us now, first on CNBC, is Robinhood co-founder and CEO Vlad Tenev. It's great to have you here.
Thanks for having me. Always a pleasure.
This is outside the box, kind of, but then again, maybe not. Maybe it all makes sense as the company branches out and becomes more of a financial services firm.
Yeah, I mean, I've been saying for a while that what we'd like to do is build a world where for our customers, all of their assets are custodied at Robinhood, and every financial transaction goes through Robinhood. And credit is just such a critical part of how. So
that's all you want to do with Robinhood is just have everybody, all their assets and everything goes through Robinhood. I think
we'll start with those two things, and then we can kind of
Did you bring the card?
Go beyond that,
because it is kind of unique. It's no fees, right?
Yeah.
3%. What do you usually get? You don't get.
So there's two.
That's nice.
Types of credit cards. Yeah, this is the solid gold one. Do you guys want to touch
gold?
it? It's literally a hunk of solid gold.
And there's no fee for that? You're going to give that to me for free?
If you're a gold member, there's no fee.
This is you got your name on it.
Yeah. So I can show it to you.
You didn't really bring. We don't. There's no Joseph Kernan card.
Well, so anyone can get that if you refer 10 friends.
I don't want to join a club that would give me one. And then you can get so 3% is more than the normal, no fees. 5%. You want people booking travel through Robinhood too.
Yeah. So typical cashback cards. We've surveyed the entire landscape. The highest that's sort of like commonly available with no limits is around 2%. And a lot of cashback cards are even lower than that, 1.5. So 3% is beyond what anyone else offers with no limit, no minimum balance, no net worth requirement to be part of the program.
How do you make money on that? Like that sounds like it's a little risky of a strategy, because the reason others are out there, I mean, unless you think everybody's not offering more just because they don't have to and they're all in collusion on doing that.
I think, credit cards are one of the most profitable segments in financial services, possibly the most profitable.
Yeah, because they don't give away that much cash. They have limits on what they set on it. They have real hefty checks that they put on people. How do you make money? Like, how does that come back?
There's two ways. So, One way is because we sort of have a vertically integrated system, we not only earn the interchange revenue, but a credit card is also a lending product. So there's revenue on balances that customers hold. And there's generally two types of customers that use credit cards. There's folks that pay off their balance in full every month, and those are called more transactors. This is obviously a great card for transactors because of the rewards, but it's also an amazing card for people that are building credit. This might be, in my opinion, one of the best credit building cards out there as well. And for customers that are using it to build their credit, we do earn the economics on those balances. And for customers that are transacting, it's all about the ecosystem benefit. And we've actually seen data on this from Robinhood Gold customers. Robinhood Gold customers are much more likely to adopt all of our other products. Their balances with us are higher. Mm-hmm. Their average revenue per user is multiples of a non-Gold customer. So once someone joins Gold, they tend to increase the amount of money they put in Robinhood. They do more with us. They're a more profitable customer. They get more value. So the idea is to just add more things to Robinhood Gold and for it to be a no-brainer value proposition. The whole idea behind Robinhood Gold is if you're a high net worth individual and you're accustomed to getting a level of service from your bank or other financial institution, we want to open up that sort of private client, high net worth experience for just $5 a month to the mass market. And that's where the retirement offer comes in. the high yield on cash, the premium credit card. All of these are products that you'd have to have a lot of money to be able to qualify for, and we're just trying to open them up to as many people as possible.
Retail's back, Vlad, and so is Robinhood. 51% this year, up 17 billion almost. Since the Bitcoin ETF, you're up 59%. Now, somewhat related. It's somewhat related, but it shouldn't necessarily. There's no meme stocks, real. I guess there are. We had Reddit, and that came public. IPO markets open. Bitcoin's at 70,000. These are animal spirits, and you probably love this world of animal spirits at this point.
We have to get you guys the Robinhood 24-hour market data so you can see what's happening in the overnight. This market close data is a little bit stale.
You're up more than 51. Is that what you're telling me, or?
Well, I mean, I think it would be good to. We have this product. Okay, 24-hour market shows the.
We'll add in the $1.19 today.
The overnight price.
Well, it's a 6% gain today. Can I just go back to the credit card? I mean, Vlad, you weathered a pretty big storm back in 2021. In January of 2021, there were issues with the capital call that came up. As a result, you had to restrict trading on the platform. You got called before Congress in February of that year. And I realize this is 3 years have gone by, but there were big issues. And the knock on you guys at the time was that you weren't savvy credit managers and risk managers at that point, that you were great technologists, but there are some issues that take place in capital markets, and that you guys got caught flat-footed on that. Yeah. When you open up and go into a credit card, I think that probably raises more questions about will you be able to effectively manage the capital flows and the potential risks that come if there's a downturn in the economy, if there's a meltdown in the markets.
I think it's fair. I mean, back in 2021, we were still a startup. We were a small company. We obviously learned a lot from everything that happened around COVID, from sort of the huge spike of retail investing to, all the events around the meme stocks. And what we have now is just an unbelievable team. And with the credit card product, we acquired this company X1, great team. Their chief credit officer was formerly running credit at Nubank, which has been very, very successful. So the team, we have grizzled veterans that went through all the events of 2021 and have kind of the scar tissue from getting past that. And then we also have amazing, experienced people that have done this before that we've brought in. And we're very excited about this product. I think customers will love it. I also think we've been very prudent about the rollout strategy. We know people are excited, but we're going to make sure that all the boxes are checked and that it's rolled out in a prudent and safe way.
Portfolio manager at Putnam Investments. I guess my point, Jackie, was that the market, on any given day, we've either thought there's going to be X cuts, Y cuts, whatever, but every day it seems like the Dow in the morning is up 150 points. And we've had a series of new highs across all the averages. I guess maybe you'd like the Fed to ease eventually, but there's other things that must be happening, other positive things.
Yes, Joe. Thank you again for having me on. I would agree with Becky. I would take the under and take no cuts for this year. I just don't think the impetus is there to generate a cut. If you just look at the macro backdrop, employment remains very strong. GDP estimates continue to rise. CPI is not really where they want it yet. And you've actually had financial conditions continue to loosen. Investment grade spreads, high yield spreads, very tight. IPO market is open again. And so I just don't see the impetus for the Fed to cut. And to your point, we have moved from 6 cuts expected coming out of the December meeting to 3, and the market has rallied up 10% right in the face of that. And so I do think there are other secular things happening. The economy's strong, the consumer's very resilient. And so if you're the Fed, I think they're just going to keep moving the cheese. We came in thinking 6, now we're at 3, and I suspect by the end of the year we're at 0, or maybe we get 1 cut. I mean, maybe we do by the end of the year get 1. And yeah, the market's been incredibly strong in the face of those changing expectations, which would not probably have been my base case coming into the year.
One of the things that has worried, people like Jamie Dimon and others, is that inflation is not totally tamed, and that if it were to continue to be sticky or even go up like it did for the first couple of months of the year, that eventually the Fed causes a recession. If that's not going to happen, and if inflation really is under control and, for whatever reasons, Fed or otherwise, if we're in a disinflationary period and the market is, and the economy is strong, is there any reason that we're going to get tripped up? What would trip us up? And if the economy stays strong with low inflation, why shouldn't the markets go up?
So I think there are two things that could be potentially, this is the what keeps me up at night. And you kind of touched on it. In the event that inflation starts to reaccelerate, I think in the last meeting, the Fed realistically widened the aperture of what they're willing to accept, right, from inflation. You saw all of their estimates go up. Their estimate for GDP went up. Their estimate for inflation went up. Their estimate for unemployment went down. And yet they were still only calling for the same 3 cuts. And so I think that they've certainly widened the aperture that maybe it's not exactly 2, that if it's in the ballpark of 2, that's going to be sufficient for them, because there are dynamics happening underneath that will have some upward pressure, just, reshoring of supply lines and different things. I think the concern and the risk to the market would be something that wasn't even in your survey, which is what if they have to go back and start hiking again, right? What if inflation does start to reaccelerate? I mean, you still have wage inflation of 4 to 5%. That isn't typically consistent with 2% of core inflation. And so in the event that they had to start reaccelerating and hiking cuts again, that's not an expectation. That would be a negative. That would obviously be negative for the markets and for equity valuations. And then the second piece is the real one that I worry about a lot, which is, we are doubling our Treasury supply in 2024. And if you get some sloppy auctions, that could put a lot of pressure on markets as well.
Could the markets, the equity markets, already kind of know that this is actually what's playing out, or is that what traders are hoping for? That growth and inflation aren't necessarily correlated or related, or that we could have growth without necessarily having hyperinflation?
Yes, I think that is what you're seeing, right? I mean, if you just go back, right, we had a very tough. The market has been running 6 to 8 months, as it always does, ahead of sort of the fundamentals. And I think what the market is telling you is you are going to probably have slightly heightened inflation. You may not get back to the 2%, but there are trends like, the generative AI trend. It's so powerful. If you think about the productivity gains that is going to create over the entire economy, not just the benefits that we're going to have in tech, but the benefits we're going to have across the entire economy, that's huge productivity gains. And that's very supportive of markets and valuations. I was meeting with an insurance company yesterday. They have 400 different use cases for AI and how that's going to improve their business, improve their productivity, improve their risk selection. That's a really powerful trend, and I think that's what you're seeing in the markets.
Apple will host its Worldwide Developers Conference on June 10th. The tech giant could reveal its long-awaited artificial intelligence strategy. Apple could use a win after a rough start to this year. Steve Kovac joins us right now with more. Steve, good morning.
Yeah, good morning. Yeah, and rough is an understatement here because, look, Apple started 2024 on the top of everything. Launch of the Vision Pro, you had returning to earnings growth for the first time in a year, the largest market cap in the world, but a slew of headwinds, and many of them, by the way, come from governments around the world, have humbled Apple this year, sending shares down about 11% year to date. All the while, its big tech peers continue to climb on the hopes of AI. Now let's run down what's going on so far this year. You have the China business, which may not be improving. We saw that iPhone sales fell 24% in the first 6 weeks of 2024 from the same period a year ago. That's according to data from Counterpoint Research. And then the EU started enforcing its tough new tech law. That's the Digital Markets Act. The EU said Monday it's investigating Apple for violations of the law, which come with steep fines. And then Apple canceled its next big thing, that self-driving car Project Titan. And last week, of course, the DOJ unleashed its wide-ranging antitrust lawsuit. So what can change this and turn things around? We'll mark down June 10th in your calendars. That's when Apple said it's going to hold its its WWDC annual developers conference, and we're likely to hear the AI plans there. And if you don't believe me, just take a look at this X post from Greg Joswiak. He is Apple's marketing boss, teasing a absolutely incredible WWDC. He did the Trump thing and capitalized the A and the I randomly.
Oh, sneaky. I was trying to figure out what was so special about that. I'm like, yeah, that's what marketing people say.
Pretty sneaky. So look, Apple's put enormous pressure on itself to, as Tim Cook has put it, break new ground in artificial intelligence. And right now, Apple doesn't have a clear AI narrative and instead has been pointing to past products and features and kind of relabeling them as artificial intelligence. Now, after WWDC and we get through the summer, there's September when Apple typically releases new iPhones. Those will need to come with some exclusive AI features to convince folks to buy, guys. At the end of the day, all about moving more iPhones.
What is the most likely path for Apple with AI? We've heard these reports about how they could be teaming up with Google.
And then in China, Baidu.
Yeah.
And this is what interests me. When we got the Baidu report, I think it was Thursday or Friday last week, that told me more. They already have a deal with Baidu over in China for search, just like they do here with obviously Google's banned over there and so forth. So that makes me wonder if this is more of an AI search thing that they're going to do and then do some other AI stuff, separately on their own on device. It's really unclear what this partnership's going to look like, but that's why WWDC is so important. What is the nature of that relationship? How much is Apple going to be relying on outside technology versus what they've been building internally?
And Tim Cook was just in China again, meeting with leaders there. And I think that's been the most, the EU, you don't know what's going to happen. China, you don't know what's going to happen if the backlash with TikTok comes, but that's a hugely important market.
Right. And it's also a symbiotic relationship, too, because Apple provides a lot of jobs for all those people manufacturing, and they have a big retail footprint and so forth out there. So, yeah, every time Tim Cook was out there, you got to pay attention to what he's saying. We don't know if he met with President Xi. A lot of other business leaders did, but it's still unclear if he got that meeting with Xi as well.
Joining us this morning, Canaccord Genuity Managing Director George Gianarikas. George, it's good to have you. Welcome back. We have seen a lot of numbers get cut. Redburn today suggested maybe flat to negative deliveries this year. Why can't it get suppressed below 170?
Look, thank you for having me on. We went through multiple geographies during the quarter, tried to discern how bad demand was, how good demand was, and clearly things aren't perfect for Tesla. There's some weakness in China in March. But I think the one thing people have to appreciate is that much of the potential weakness in deliveries this quarter has to do with supply constraints. They've had some issues with making a new updated Model 3 in Fremont. And don't forget that the Cybertruck isn't fully ramped yet. We assume that maybe they'll make 5,000 and deliver 5,000 in Q1. And they have the capacity to deliver over 60,000 a quarter. So things aren't that bad. And actually, if you add those things back, it should result in year-over-year growth. So it's not perfect, but we don't think it's as bad as people think it is.
Are you a fan of the theory, and some have written this, that the price cuts have actually worked a bit?
Well, look, interesting question. They cut prices a lot last year, and clearly it helped volumes, and it's helping this year. But what's interesting, what we put in our note today, is that the price cuts haven't been there so far this quarter. I mean, maybe a little bit here in China and in South Korea, but overwhelmingly, the tone has shifted dramatically in price cuts. This quarter in the U.S., they actually increased prices 4 times, with another one due on April 1st. And some people have speculated that maybe to induce demand to get people to hurry to the website and buy a car today. But I think it's more than that. I think hopefully we'll see that result in margin improvement throughout 2024. But also it may indicate that things might not be as bad as people think.
What's happening with your China estimates, though, after Musk complained last quarter about the competition and the subsidies from competitors?
It's a great question. So, look, in China, if you combine, we have data that comes out every week. It's publicly available. If you combine January and February, because there's some changes in the timing of the new year, we're actually up year over year. Where we think the weakness is probably in March. We had 3 weeks of reports. We got one yesterday, and those were down year over year. So there seems to be some slippage. And some competitors in China, NIO and Li Auto, actually pre-announced negative over the last couple of days. So China's not great, but again, they operate in multiple geographies, and there has been some pockets of goodness whether it's, European numbers were good for the first 2 months. U.S. is probably not that bad. And we think that demand for this new Model 3 is actually really good. It's just that they haven't been able to make as many as they hoped.
I know for Q1 deliveries, you're looking at, you lowered to 420K, right?
Yes, correct.
You think the street's gotten conservative enough that next week might actually be all right?
Yeah, look, it's hard to discern exactly where the whisper is, but probably in the low 400 range, below the 420. And, we think that's the over-under. If it's over that, we think the stock goes up. And again, what we try to do a little bit is reframe the debate. It's a little bit of supply in there, too. We estimate about 95,000 units if they were at full capacity at the Cybertruck, full capacity of the new Model 3, and maybe 10,000 units out of Europe due to some fires at Giga Berlin.
Right. And I think you've still got a two-handle on full-year deliveries, which not everybody does. Finally, do you see a lot of political risk if there's a change in the administration?
Yeah, I mean, look, they do. Those EV subsidies do help Tesla. We think that the majority of people who buy a Tesla today are being helped by a $7,500 tax credit. That could change. We'll see if there's a new administration, and there's clearly some risk to that. But we think that over time, the inevitable shift to EVs is going to happen, and Tesla will be a leader. So there may be some bumpiness, but if you look, have a little duration, they should be a winner long term.